Housing doesn't just reflect the economy, it often leads it. And right now, housing is quietly turning into the next pressure point. When rates rise, housing feels it first, almost immediately. Because housing is built on financing, affordability, and confidence. Housing stress isn't one thing. It's a chain reaction. First, higher rates reduce affordability. Monthly payments rise, even if prices don't move. That pushes buyers out of the market, then demand drops. Days on market rises, price cuts increase, and transaction volume slows. That volume drop matters more than people realize. Volume is the heartbeat of housing. When transactions slow, the entire housing economy slows with it. Fewer sales means fewer mortgages written, fewer refinancing deals, less spending on renovations, appliances, moving services, and local contractors. Even local government revenue can weaken as activity slows and fee income declines. This is why housing is so economically powerful. It doesn't only affect prices, it affects activity. And activity is what drives jobs and cash flow across an entire ecosystem. Prices can stay flat while the housing economy weakens underneath. That's what makes volume one of the earliest warning signals. Because housing doesn't just drive construction. It drives mortgage lending, home improvement spending, furniture, appliances, and local services. A slow housing market reduces activity across multiple sectors. And the next stage is psychological. When buyers believe prices might fall, they wait. When sellers believe prices might fall, they rush. That shift in behavior can amplify the cycle. Now here's where housing stress becomes more serious. It's not only about new buyers. It's also about existing homeowners and their cash flow. In high-rate environments, delinquencies tend to show up later, not immediately. People adjust slowly. They cut spending first. They use credit cards. They stretch payments. And only later does stress show up in missed payments. This is why housing can act like a delayed pressure gauge. The affordability shock happens first. The delinquency signal often comes later. And that delay matters. Because markets often relax when prices stop rising, assuming the risk is past. But household stress shows up later, when savings thin out and debt costs stay high. That's when delinquencies start confirming what affordability already signaled. Now zoom out to the structural risks. Housing stress spreads faster when three things overlap. High rates, stretched prices relative to incomes, and tightening credit standards. Credit standards matter more than headlines. If lenders tighten, higher down payments, stricter approvals, less risk, the market can freeze even if demand exists. Because demand without financing is not demand. A tight credit environment reduces transaction volume further. That reduces liquidity in the housing market. And when housing becomes illiquid, price discovery becomes messy. You don't see a smooth decline, you see gaps. Some homes sell, others sit. This is how housing creates regional divergence. Some cities stay resilient, others weaken quickly. The key risk isn't only lower home prices, it's the second-order effects. Construction slows, permits decline, contractors see fewer jobs, municipal revenues can weaken, and consumer confidence drops. Housing is one of the few parts of the economy that people feel emotionally. It's tied to security, wealth, and stability. So when housing weakens, people often behave more cautiously, even outside housing. Now let's talk about what to watch. The signals that tell you whether housing stress is becoming macro stress. 1. Mortgage rates and affordability indexes. If rates stay elevated, affordability stays pressured. 2. Transaction volume. Volume usually breaks before prices do. 3. Delinquencies and default trends. If they rise consistently, stress is spreading beyond buyers into household balance sheets. 4. Lending standards. If banks tighten, housing slows even if demand exists. 5. Construction activity. Permits and starts tell you whether housing is becoming a growth drag. Housing stress doesn't guarantee recession, but it raises the probability of broader slowdown when credit is tight. Consumer finances are stretched, and rates stay high for longer. Housing is a pressure point because it amplifies. It doesn't just slow one sector. It slows an entire network of spending. So if you're watching the economy, don't only stare at GDP headlines, watch housing. Because housing often tells you what the next chapter looks like before the rest of the data catches up. Housing stress begins quietly, but when it compounds, it becomes a macro story.